Good morning, everybody. I hope everybody can hear me loud and clear. Thank you so much, first of all, for taking out time for logging on to this webinar. And over the next 30 to 40 minutes, we will be discussing how the general markets have behaved over the last few weeks. What is the market status and how the methodology at William O'Neill stroke CanSlim is actually working out, and the uh, the signs that one should take out from whatever carnage that we've seen over the past few weeks. So before I start the presentation, I hope everybody is safe, everybody is healthy, and everybody is maintaining all the norms that are required to be maintained during this lockdown. We're having social distancing, and we are communicating as we are through digital modes and mediums. So largely, I think the markets over the last few weeks have gone through a huge volatile roller coaster. A lot of comparisons have been done, and we've done a couple of reports over the last 2 weeks in attempting to find out how the previous crises have unfolded and what is so different this time around. If you look at a lot of the earlier crises, and if you've gone through our earlier reports in terms of whether history will repeat itself, how the market bottoming out processes were formed in the previous crisis, whether it was the 2004 crisis, the global financial crisis in 2008, 2011, or the 2015 crisis. I think each of these crises had certain elements of their own. But this time round, I think it's a combination of uh, factors beyond uh, the known uh, parables as human mankind would put through. So I think it's a typical period which nobody anticipated, and the contagion effect of COVID-19 has taken global economies by storm. So 2008 again, I think for the better part of repeating myself, was more of financial deleveraging. It was more of a financial crisis at that point of time. 2020, I think it's a combination of both. I think it's financial deleveraging and economic deleveraging which is playing out, which has not been seen anytime in the past. If you look at 2008, which is the most common parallel that gets drawn out, yes, I think it was because of the excesses created in the mortgage market. But what followed through and the actions that the central bankers and the regulators and the respective governments took to take care of how the entire financial deleveraging was taking place, I think the understanding part took some time. And that's why I think the entire knockdown, knee-jerk reactions that one saw during the initial part of the fall did sustain over a period of time, though the bottom out process took a long, long time for 2008 crisis. So from the first fall in Jan 2008, the Nifty or the index bottomed out in October 2008. So that was a pretty lengthy period of time for the entire bottoming out process to take place. This time round, I think the fall has been pretty sharp. So if you see how the Indian markets or the global equity markets have reacted to this scenario at hand, the fall was pretty stark, the fall was pretty sharp. And again, I think a lot of participants have got stuck up at the wrong end of the curve. Now, the obvious reactions which happen after such a steep fall is have the markets become very, very attractive? Have they become absolutely a good entry point to start buying stock which have fallen 30, 40, 50, 60 odd percent? There are other parallel arguments that get drawn out. That if you probably look at longer term valuations, valuations obviously were elevated uh, during this market rally as well before the fall took place. But they've become very, very attractive right now, whether you talk about a price earnings multiple, a price to book multiple, or a price to adjusted book multiple, or even if you look at book values for certain sectors that the economies are concerned with. But a large element is still the unknown that we are dealing with. Yes, this time round, the central bankers, the regulators have all jumped in and they have proactively taken the steps from all the previous crises that we've probably witnessed and seen. So the stimulus packages that get announced. I think a request is if you can move, if all the participants can mute their audios because it's creating a little bit of a disturbance, right? Yeah. So I think the entire thesis here is the large unknown in terms of the impact. Though I think the stimuluses have got announced quite significantly by a lot of central governments, as I said. The packages that have got announced, the US bailout package, for example, of $2 trillion odd dollars, which is 10% of the GDP. The French government has announced a huge package. The Chinese, the Japanese, the Canadian governments, the British government. So I think the governments across the world have basically initiated strong actions in terms of being there to infuse liquidity and to probably bail out a lot of industries which are facing the heat at this point of time. We must be to multiple reports, multiple articles in terms of the after effects which have already started coming through. So for all the sectors which will basically feel the heat at this point of time, whether that's aviation, hospitality, leisure, I think all these sectors are going to see huge earnings downgrades going forward. There have already been news of layoffs happening within the aviation stroke hospitality sector itself. And again, I think the kind of compound effect that one really expects to come through this lingers on longer than one really expects, because you're not really sure on how this entire impasse, specifically related to these lockdowns, will play out over the next few weeks. So I think we've got our fingers crossed that this hopefully should get over sooner. But I think the implications and the long drawn downgrades and the financial strains that it leaves on the global economy, on sectors, and respectively on earnings of these companies, which then ultimately reflect on the markets itself, because markets is nothing but a slave on how corporates perform and how corporate earnings ultimately play out. So I think the ultimate reaction does get played out. And markets, as we know, I think start discounting all of these future events a couple of quarters or 3 quarters beforehand. But again, I think the stark difference, as I'm again pointing out, is the actual facts in terms of the economic impact that will get felt, not just across the sectors which are at the forefront or facing the brunt at this point of time, but the indirect implications that get played out. So, for example, I think the banking sector is feeling the brunt because the markets are not really sure on how the entire book value will play out. And the logic obviously is absolutely correct. I think if you probably look at phases of lockdowns, I think how is the loan growth going to take place? For the Indian context particularly, I think the non-food credit growth, which is again the advances growth that we look at for the financial universe, whether it's banks or NBFCs, but growing at a very dismal pace of around 7.5 to 8% odd. So I think with lockdowns coming through, I think with businesses expected to again show very slow and steady growth up the curve in terms of their earnings dynamics, and with demand itself expected to come back very slowly and softly, with the assumptions that the layoffs do not happen at the pace that they are, because the figure that the US threw out in terms of unemployment claims at 6.8 million was very steep, and this figure can actually start going higher and higher. Because it's not just these sectors. I think with crude crashing off, and though Trump had evinced a huge interest through his tweet that the Saudis and the Russians might get together, and that had a huge spike in terms of Brent pricing, whether it sustains is very critical. And there were a couple of filings for bankruptcy by a few shale companies out in the US. How the Middle East economies will play out, specifically in a scenario when Brent probably stays at such a low level, and where the dependency on crude, real estate, and a lot of other sectors, which include Spain and Italy, for example. I think the numbers for Spain that I was reading through yesterday night in terms of unemployment have shot up significantly. So there are almost 6.5, 7 lakh claims that have got filed for an economy which depends primarily on tourism. So 14% of its GDP is on tourism. When I was doing some stat checks, even between the earlier crisis periods for the US markets in particular, when you saw the dot-com bubble probably burst through, the kind of layoffs that took place at that point of time 20 years back was 2 million workers got laid off. The Fed again at that point of time had come to the rescue of the market by significantly reducing its interest rates, which they've also done this time around, got it very, very close to zero. But again, I think the kind of estimations that one really can make out in terms of the estimations of job losses and the repercussions that it has on the economy because of the strain that it leaves, because of unemployment concerns, because of demand catching up very, very slowly, plays out on earnings, and that ultimately, as I said, plays out in terms of how the markets will react. So at this point of time, I think it's a combination of both. I think it's not just financial deleveraging that is happening, but also the unknown in terms of the economic deleveraging that is taking place. It's over the next few weeks and months that the exact impact and implications of how this entire pandemic has left across sectors, across GDPs for a lot of the economies, whether it's the developed economies or the developing economies, which also depend very, very strongly in terms of foreign flows or capital, which probably is the need of the hour to sustain their economies and their GDP growth. I think all these all these questions rather need to be answered, and that will come through at an appropriate period of time. What has also happened is that this entire scenario has prompted a lot of agencies around the world, whether it's the IMF, whether it's the World Bank, whether it's the rating agencies, to cut off GDPs very, very sharply because they're not expecting GDPs to actually stage a V-shaped recovery, though the markets can. But a large element in terms of having a GDP recovery which can be very, very sharp looks very, very patchy at this point of time. Therefore, I think the entire attempt in trying to place our bets in where a bottom for this market might be becomes a very, very difficult scenario. Even in the past few crisis periods, finding a market bottom has been a guessing game, right? It's only hindsight that we can presume that markets bottom were formed. So even in the reports that we had generated, I think there were certain elements which probably prompted the market to correct to abysmally low levels. But as things started becoming clear, as the market started getting some amount of visibility in terms of how the forward clues and cues will be, the stability for those markets came through. There was a period in terms of exuberance that we probably also see. So I think all of you would have seen in the past as well, when bear markets play out, and when all the global markets have corrected in excess of 25, 30 odd percent, there are pullback rallies that are also witnessed in the market. And it's a very, very obvious scenario. I think these pullback rallies can be to the extent of 15, 20, 25 odd percent. But are they sustainable is the question that we should ask ourselves. Going by history, in typical bear markets, I think these pullback rallies do take place, but the markets again try to test its lows because of the uncertainty that is created. And because the confidence factor probably does not exist in the market consistently over a period of time. So unless there is visibility that the markets can foresee, and the market data obviously throws that at us, I think the markets will find it very, very difficult to find its feet. And before they find their feet, I think there is obviously a couple of reactions or chain reactions that come through in terms of the market moment itself. So with that respect, I would like to take you through the presentation that we brought this time around. I think most of you will be aware of O'Neill's or William O'Neill's methodology in terms of how do we identify market direction. But for the purpose of repeating myself again, I think I'll quickly take you through how the market setup is at this point of time, the importance of market direction, and why follow-through days are extremely critical at this juncture of the market in identifying how the entire scenario will be. Once we are through with the entire discussion, I'll take you through sector discussions in terms of how the Indian markets are placed at this point of time very, very briefly. And then we'll have a quick question and answer session, which will also be attended by my co-host Roshit. And we will take up some questions at the end of the session as well. So I'll be going through the presentation at this point of time in just the next 1 to 2 minutes. I think very standard disclaimer. I think whatever you're discussing this webinar is just a standard uh, discussion in terms of how the markets are placed, so on and so forth. So this should not be considered in any way as an investment advice. I think again, what does CANSLIM basically mean, and what does CANSLIM basically do? So each letter of CANSLIM has a particular attribute assigned to it. So there is an earnings angle, there is an N angle, which so the current earnings is C, the annualized earnings is A. When you're talking about the N factor, is the newness factor in terms of new factors, new innovations, any newness that the company has got an offer to exhibit. The S factor is the supply demand dynamics in terms of how the entire approach for the stock is both from an institution as a retail perspective. The L stands for the leader or the Lagarde positioning that the stock has. So we normally ideally prefer leadership stocks because these stocks are somewhere where the earnings resilience remains extremely strong. So the C and the A part remains extremely resilient. That supply demand dynamics and the N factor also remains very, very strongly skewed in favor of the leaders. The I is the institutional stack up of the institutional holding that the firms or the companies have. A strong institution holding is obviously a very, very good sign. So how the institution holding is waking up or going higher is a very, very good sign for stocks, which is also an ideal attribute to take into account. And the M is the market direction, which I'll be talking in detail. So I think the elements combine fundamentals, technicals, and also the market direction in place. So I think a whole host of factors are taking into account in terms of checking out the eligibility, in terms of how the stock is placed, how the stock how the stock is doing from an earning return ratio perspective, specifically ROEs, and how much of an installation of confidence is exhibited in the stock through institution holdings. So sales, earnings, profitability, the newness in product, services that it has to offer, the leadership within that are covered and are exhibited through the stock data points in terms of P&L, their balance sheet, and that gets reflected in the CANSLIM methodology through the fundamentals. The technicals obviously are reflected within the product itself in terms of how the charting tools are devised at MarketsNet India, and that is itself displayed without any human bias in terms of the chart patterns that the stock is forming. Because if the stock has strong fundamentals, but if you're not able to time either the entry or the exit into these stocks correctly, I think there is no point in terms of trying to make a reasonable ROI through the market. So the technicals for CANSLIM and the criteria we probably have and go through encompass all the different patterns that the respective stocks or sectors are making, and the price and the volume action related to the same. And the market direction is how the markets are at this point of time, and how the market direction will basically help you in timing either your entry or ensuring that you exit the market at the right periodicity of time. So I think the second and the third point in this slide is extremely important. I think what we are saying is that the fundamentals of stocks remain very, very solid. But as market conditions change, and as market conditions are changing right now, when you're probably looking at the deleveraging aspect, when you're probably looking at how the entire market is placed at this point of time, it becomes extremely critical to take into cognizance how the market direction is. So the market direction is obviously going downwards, going southwards. There is no point in trying to challenge the market at this point of time, because there might be arguments in terms of buying into dips into the market. But over the past few weeks, I think the market has been so volatile. I think it's been a natural course of action for the markets to probably go up 4%. But I think the natural downward days of going down 4% has become a more common occurrence in the market. So I think staying with the market direction is extremely critical, because a lot of stocks and sectors will perform and will follow the market direction itself. Though some might be outliers, but I think a general thumb rule is that one really needs to look at the market direction in terms of creating or looking forward in terms of how to time the market. So I think if the market is going southward, I think there is no point in challenging that. You sit on the sidelines if the market is in correction. So in the past few weeks, I think once we had identified that the number of distribution days, which I'll go and touch upon very, very briefly, had started increasing, I think we had made suggestions to all our clients way beforehand that you probably get out of the market, not the right time, it's not conducive, and that's worked out beautifully. At this point of time, again, we are very, very cautious in the market, and we are still trying to say that we conserve capital, because at this point of time, as I pointed out, I think the uncertainties that are there in the market, and I put out certain facts and stats in terms of how the market move has been in the next few slides, which will elucidate the point that I'm trying to try. Now, this is how we stack up the market direction at William O'Neill. So I think there are 4 large stages in terms of how the market positions itself over different periodicities of time. So I think the rally attempt is an obvious no-brainer. I think the markets are rallying. It has got a significant amount of strength related to the price volume action that we probably see. The supply in the market in terms of how the markets are positioned, and the demand thereof, I think, is extremely strong for the market. The institution activity becomes extremely strong. So there is no two ways in terms of how stocks, sectors perform, and they perform exceedingly well. So certain sectors and stocks perform better than the others. Now, when you're probably looking at the right-hand side of this chart, the under pressure element of the market happens when 3 to 4 distribution days are observed in 3 to 4 weeks. So let me take you through what a distribution day is. So a distribution day is nothing but when one or major stock indices, so if you take into account Nifty, for example, it falls more than 0.2%. So if the Nifty falls more than 0.2% in one day on higher volume than the previous session, you can account that to be a distribution day, right? So this is a very simple methodology in terms of how do you stack up how the market direction is playing out. So if such a day happens, I think you can count that to be one distribution day that has taken place in the market itself. As the market starts piling up these distribution days, there are obviously some onerous signs that you can start building up. That there is some signs that the market is throwing at us where you should start becoming a little more cautious. And then that cautious elements actually get played out in terms of the larger market direction. So again, if we go through the entire chart, the rally attempt is something that we've seen on the right hand side. If the 3 to 4 distribution days are observed in 3 to 4 weeks, so if you get a 0.2% correction on volumes higher than the previous day, you got one distribution day. If that count increases to 3 or 4 within 3 to 4 weeks, there is some element in terms of the market coming under pressure. So the under pressure element gives you the signs, or starts giving you those signs that there is something which is a little bit dicey in the markets, and one should start becoming observant. One should not be taking aggressive positions at this point of time. In fact, if one has got positions and one is making reasonable amount of profits on certain positions that he's carrying or she's carrying out in the markets, they should probably be looking at partially exiting that or taking some money off the table if this distribution day count increases. So the market clearly will start coming under pressure if there are 3 to 4 distribution days that are observed within 3 to 4 weeks. Now that under pressure market status is observed in those 3 to 4 weeks, and in the next couple of weeks, if the number of distribution day or that count goes higher, or the number of days go higher by 2 to 3 compared to the earlier count that we've got, and it starts piling up and it becomes 4 to 6 or higher, you've obviously got something which is wrong. The market is sensing that something is wrong and it is throwing out signals to you. Maybe the correction in the markets might not be as stark that we are observing in volatile times like these. But yes, there are corrections which are happening in terms of higher volumes. There are obvious technical indicators which are getting played out where the markets are coming very, very close to its moving averages, whether it's the 50 DMA, whether it's the 200 DMA. And if those volumes start increasing on a daily basis and they start correcting in terms of the number of trading sessions that gets stacked up along with the number of distribution days and moving averages getting breached, it is an obvious sign that the market direction is changing for the worse and not for the better. So at that point of time, I think the markets are going to go into a corrective mode, and it's better that you start offloading your position get into cash, conserve your capital, and then wait for the market direction to probably change before you start committing all the capital that you've probably taken out of the market getting deployed back. So I think this phase typically got played out over the last few weeks as the pandemic started spreading its wings around the first or second week of January. I think a lot of people and participants were taking it easy because the markets itself had not exhibited any signs. But some signs had started coming off from the middle of Jan as the number of distribution days started increasing. There were some pullback attempts as well during that period of time. But again, I think the stack up in terms of the distribution days over the periodicity that we're mentioning in 3 to 4 weeks had started coming through. So the obvious signs had started happening from the middle of Jan till the end of Jan, first week of February for this fiscal year itself in the market crises that we're seeing. And this got obviously played out in terms of some profit booking elements that we did. Now, as distribution days started stacking up over the next few weeks, I think we offloaded our positions completely and we came out of markets and we asked all our investors to probably stay on the sidelines and conserve their capital. The market then went into a corrective mode because I think as the implications in terms of the pandemic and the global scale that it started reaching out to be, I think that started creating nervousness. I think institution money started getting rolled out of the markets. What started happening also was a lot of safe haven buying started taking place because all the institution money which was coming out either through the emerging markets and not just India, or even through the developed markets, started getting deployed into US treasuries, in US corporate bonds, into gold to a certain extent. So I think all the safe haven buying actually started coming through because obviously a risk off scenario was clearly getting played out. You had multiple reasons that also started coming out after the market showed significant amount of crackdown and correction, and that was pretty stark. And that was also a major difference of what we've probably seen in the previous crisis periods. The previous crisis, whether you talk about 2004, 8, 11, 15, I think these knee-jerk reactions and the bottom-out processes had taken a long, long period of time. Here, the quantum of correction that has happened of almost 30, 35 odd percent from the top, and the number of trading sessions that it has taken is comparatively lesser, whether you talk about our indices, whether you talk about the Dow or the S&P, the DAX, the CAC, the FTSE, or any global equity market for that matter, has been pretty stark. And there, I think the reality comes through of the entire financial and the economic uncertainty is still playing out in terms of how the market positioning will be. So clearly, I think the market went into a corrective mode. The last week, as I said again, I think not just for our markets, but for global markets and indices as well, you had the pullback rallies which started off. So the pullback rallies came in thick and fast. So I'll put in some stats. I think it's very, very interesting numbers at this point of time. So from the all-time high, the Nifty over the past few weeks, and March 24th to be precise, it actually touched a level of 7,511. And there again, I think what we'd seen in the past, like 2008, I think you saw lower circuit actually getting played out. And again, I think there was an expected breach of another 5% actually being hit on that particular day itself. However, I think the market has taken that bottom of 7511, and in fact, it rallied on that same day itself. And there was a significant rally which played out for the Nifty from those levels itself. The 7511 was where I think the ultimate low is, at least till this point of time, and it is also an intraday low which still stands, and also a corrective low for the indices or the Indian markets at this point of time. Over the next couple of days, I think there was obviously an intraday high that the markets created, and on March 27th, the Nifty touched 9,038 odd levels. So from the intraday low of March 24th of 7511 to an intraday high of 9038, I think there was a 20-21% rally that the markets actually exhibited. But again, as I said earlier as well, I think it's not just for Indian markets, even the Dow or the S&P pulled back very, very sharply during the past week or 7 days. Again, I think there was a lot of reasoning given out for the pullback in the Dow and the S&P. A lot of rebalancing expected from a lot of bond funds, algos probably rebalancing themselves at the end of the quarter. Again, I think the money which had got pulled out earlier, the money which had got deployed in bonds, were getting rebalanced, and the rally was largely attributed to the rebalancing factor. Though the concerns related to the economic recovery largely still remained very, very strong, and that overhang on the market still remained very, very clear. From that level itself, I think on March 31st, right, on a closing day basis, you had the Nifty, which closed at 8,600, but it made a day high of 8,650 odd. So you can see the swings that the market had done. So March 24th, 7511, and we were in a corrective fashion at that point of time. But again, I think what our methodology suggests is that if there are 3 consistent days of strong action that the market sees, both in terms of strong follow through, in terms of price action, as well as volumes picking up, I think, and if those 3 days are maintained in terms of positive action, though I think it does not need to undercut the low that it's created, which is 7511, because that was the intraday low as well as the corrective low at that point of time, the market remains in a rally attempt. So that rally attempt clearly got played out because, as I mentioned, 7511 on March 24th, you did have an intraday high, though it closed a little bit lower. The market did on those 3 days manage to have better volume and better positive traction without undercutting the lows of 7511 that it had created. On March 31st, after these 3 days were played out, is the concept called as the follow through day, which ultimately leads us back to the rally attempt. Did we get a follow through day? Absolutely yes, we did get a follow through day, and I'll explain what a follow through day is and why a follow through day is very, very important and critical, and how you need to be cognizant of also following the right follow through day in market conditions like these. So again, I think the rally, the under pressure, the corrective phase, as I explained, got played out. The rally attempt phase, as I also mentioned, got played out over the past few weeks, which has happened in the past few days itself, where you got 3 consecutive days of good action without the Nifty undercutting its lows. And we also got a follow through day, which led us to a confirmed uptrend. But was this confirmed uptrend sustainable? Is this confirmed uptrend still the one that we probably are looking at in this rally attempt itself? I think those are the questions which we'll try to answer at this point of time. What a follow through day is something that I will now take you through. So ideally, as I said, in terms of identifying the market direction, the first 3 days got played out. As I said, the follow through day ideally happens after these first 3 days of the rally attempt play out. And ideally between 4 to 25 days after the rally attempt has played out, the FTD or the follow through day actually takes place. So again, I think what a follow through day is and how do you spot it? So when a market makes a new low, as we've seen it is earlier as well, as long as the index stays above its prior low, the attempted rally stays in place. So as I mentioned earlier, and I'll go back to this slide, the first 3 days of this rally attempt and what the intraday low or the corrective low that Nifty had made on March 24th of 7511, unless that level holds up, I think that rally attempt status in the market stays put. The confirmed uptrend in the market also stays put, unless we've got the number of distribution days, as I mentioned earlier, start stacking up over the next few weeks, and we are expected then to change market direction to markets under pressure. If these counts start increasing, which will give us signs that there is periodicities of uncertainty in the market, and the market data is telling us that the sustainability and the stability of the markets might not probably stay put. So follow through day is nothing but when an index, for this matter, I think if you take into account Nifty or the Sensex closes 1.5 to 2% higher, and the higher part is the index moment itself, and on volumes which are higher than the previous day. So here the critical part is that the volumes need not be above average, or they need not be exceptional volumes at play. These volumes need to be volumes which are higher than the previous day in question. So when does that typically happen? It happens after day 4 and 25. Ideally, I think between the 4th and the 7th day, if this happens, I think it's an ideal situation that we probably got. If it probably takes a little bit longer, I think there is some element in terms of weakness that the market is trying to exhibit, because the market is probably trying to find its feet. But again, I think that point of time, you probably need to be a little bit more cautious. So what we've seen through all these attempts is that when the index is in a rally attempt, it can go back to a correction, right? Because if the number of distribution days start stacking up, I think the rally attempt might fail. The second element to take into account is that the correction low. And again, I think 7511 is an important level that one needs to keep into mind, needs to keep into cognizance at this point of time. If it breaches that over the next few weeks, I think the rally attempt might be failing at that point of time. So again, I think looking at the market context at this point of time, the weakness in terms of market data, the weakness in terms of the volatility, the weak spike that we've seen, though I think measures have been taken by SEBI in terms of increasing margins, in terms of increasing the lot sizes to create some amount of confidence and to probably take the compulsory shorters out of the market at this time. I think the element in terms of market data and how the entire curve related to COVID-19 actually starts flattening out, I think the next few weeks remain extremely critical for the market. So again, largely, I think the follow-through day has got witnessed. We did witness a follow-through day of March 31st when the index attempted a moment of more than 1.5 to 2%. It made an intraday high of 8680, as I said, and we finally closed at 8,600. So the confirmed uptrend stays in the market, but whether it sustains is something that we will discuss going forward as well. So FTD is again very important because I think the market trend changes because of a follow-through day. The market direction changes because of follow-through day, and this also gives a fair bit of an idea in terms of the resilience for certain stocks, certain sectors, and certain stocks having leadership plays within those sectors to actually show us eminent signs in terms of getting into the market. So I think two elements here. I think how the base formations have been for these sectors during this phase that we are talking about, and how the fundamentals are stacking up for these sectors as per the cancellation methodology itself. So this is what the market moment had been. So when you saw the all-time high getting created on 12,431 on Jan 20th, 2020, the market mode, as I said, if you see the second aspect, was changed into a corrective mode because of the two elements that we've seen from the all-time high. If you probably see from Jan 20th to the market status change that happened over the next few weeks, the number of distribution days had started stacking up. If you look at the middle element, if you can observe that, the 11,615 which had taken place, which was a reasonable 7-8% correction from the all-time high. From there, the market again attempted a brief pullback rally. So there again, I think the pullback rally took the index up to that 12,250 odd mark. And from there again, I think the number of counts started increasing at a very heavy pace over the next few days and the next few weeks in terms of trading sessions. And that volume increase along with price action that one was seeing in the market, and one can attribute it for multiple reasons. I think the prime and foremost reason will be the after effects on how the pandemic will play out, or the valuations were too expensive. I think all that is in hindsight, but the market was throwing out signs at us that you should probably be on the sidelines, and that was a clear breach in terms of the 200 DMA that the market took out ultimately. And there at that point of time, I think it was an obvious and an ominous sign that you had to get out of the market. Whether you liked it or not, the technical signs in the market were telling you very clearly, strongly, and very loudly that आपको market के बाहर निकलना है. Get out of the market, stay out of cash, stay on cash, conserve your capital. Obviously, I think what followed suit is again in hindsight because the kind of implications that it had, the global effect that it had, the pandemic and the lockdowns that we are now seeing globally, and the economic repercussions are clearly getting played out. So between March 24th, again, as I said, when the markets touched an intraday low of 7511, when the Nifty again attempted a strong rally at that point of time, and when those attempted rally days took place, the 3 days in tandem, 8,083 was touched. There was an intraday high on March 27 of 9,038. That was a substantial 21% from the intraday low of 7511 to the all-time high. Again, I think the typical move that got seen between Jan 20th and the market correction days, when it corrected to 11,615, but again bounced back 5 to 6%. So I think these typical movements happened, but in knee-jerk reactions like these, there are pullback attempts of 20-25%, which also take place, which we've also seen from the intraday high of 9,038. What has happened post that? I think the Nifty again has clawed back quite significantly because the data points that are getting thrown out, both in terms of both in terms of volumes as well as investor interest, investor sentiments. I think if you take all that things into account, the current Nifty level of 8,080, I think there again has been a substantial correction from levels of 8,600 on March 31st, when the market status obviously got changed to confirmed uptrend. So I think we are still reasonably down. I think we're still 7-8% down, and we've seen that pullback happen from that follow-through day, or the market status we got changed because of the follow-through date that was observed on March 31st. So again, I think over the next few slides, I will take you back through the earlier crisis periods and how you should be careful, even if a follow-through day has been observed. I think the elements of observing for the right direction for the market to create the right base, and whether I think you should wait out and be a little bit cautious in terms of taking positions, considering the positioning on where the markets are at this point of time, remain extremely critical. Now, March 31st, 8,600, yes, the follow-through day was observed. The market did go to a confirmed uptrend. But look at the scenario where the markets are placed. So the next day, I think the markets corrected by 4.5%. So one might very well argue that did the follow-through day tail off? Again, I think the fall in the market of 4.5% that took place immediately after March 31st on the 1st of April. Again, I think that was on very, very low volume. So if you probably take into account whether a distribution day got added up on the 1st of April, it did not, because I think the volume which was there on April 1st compared to March 31st was lesser. And because it was lesser, I think there was no element to believe that the market had some element in terms of weakness that got exhibited through additional distribution day getting counted off. However, I think if you probably look at the technical setup even now, and when you probably talk about the market from the all-time high to the level of 8,080 sitting on, it's still the corrective mode that we've seen for the market. So I think the technical recessionary factors that one really needs to count globally on the fundamental scale, how PMIs are playing out, are also extremely soft at this point of time. How that count probably takes place along with the data points shown out by IIP data, the data points shown out in terms of the GDP statistics stacking up for a quarter. I think all these elements are playing out that the fundamental recessionary factors are also probably at play. So I think there was a 20% retracement that we've seen from all-time highs. The key moving averages are still way off that we are looking at. The volatility index it pulled on high again. Relative higher least if you up any lead stock, I think are buying a few stocks within the FMCG universe, within the Nifty pack. I think all leading stocks from leading sectors itself are still not showing signs of strength. So I think there are inherent signs of all these four factors at play, which still do not give the confidence that this follow-through day might actually have legs to take the market higher, stronger, and in a more stable fashion. So I think with this context, I think what you probably looked at, how the Nifty is positioned, how we are, I'll probably take you to how the previous actions have happened. It's a very, very pertinent and ardent quote that Randy Watts, our global CIO, has put out. So what we believe, both globally as well as domestically at this point of time, is though it is an excellent opportunity to buy stock, I think you need to have proper technical signals before getting into the market. So I think you need to probably observe what the market is throwing at us, and that is very, very critical in terms of timing your purchases. So I think the next few weeks is an observable phase. This is a phase, I think, where we've also put out a lot of stocks in our buy watch list. So the buy watch list has got created specifically and curated so that all the actions that we probably see over the next few weeks, and if the market throws the signs, if the Nifty does not undercut its lows over the next few weeks, if we do not have further distribution counts, and if we get a very, very stable consolidated base over the next few weeks, taking into account of all these things, and if strong sectors and strong leaders within those strong sectors show signs of stability, I think those buy watch list stocks will come into play, and then they can be aggressively looked at. But again, I think following a pyramiding approach and cautiously waiting till that point of time, I think becomes a very, very important sign, because I think the technical signs still are not there. Though I think value has started emerging significantly in a lot of pockets. So as I discussed in my earlier webinar as well, I think how do you differentiate between value and price? Obviously, I think price is something that gets thrown out on the screen in terms of how the CMPs are played out for a lot of stocks in action. But value is something which deteriorates in terms of the futuristic predictions that the stocks or the sectors can exhibit. So the markets have already started pricing in value deterioration for a lot of stocks. You'll obviously get a lot of reports coming through over the next few weeks. We've already seen GDP downgrades, as I've said, but a lot of earnings downgrades will start taking place. The uncertainty element is in terms of the shocker that can happen from a volume and a price degrowth for a lot of sectors and a lot of companies at play, which makes it very, very difficult for analysts to point out whether it will be a higher single-digit earnings degrowth or a double-digit earnings degrowth at this point of time. But a large consensus is pointing out that it will be in the higher single digits or higher double digits, around 11 to 12%, from 8 to 9 to 11 to 12% in terms of earnings downgrades that the markets can probably have for sectors. For some sectors, as I said, aviation, hospitality, film exhibition, ledgers, sectors, the earnings downgrade can be even starker that you probably see. So the value is clearly getting deteriorated. It is also getting thrown out in terms of earnings multiples getting contracted, both for the market, for the sector, and for the stock in use as well, for the stock in perspective. But when do you probably get into these stocks? I think the technical basis will tell you for all these strong fundamental counters, for all these leaders at play on when to get in. So again, how follow-through days have played out in the past and how they actually took out in terms of earlier crisis is something that we'll discuss going forward. So I think third important aspect in this presentation or on this slide is a very important point to be observed. The follow-through day will likely fail if we see instant distribution above major averages combined with ideas reversing of levels of resistance or pulling back of the respective basis after breaking out. We will generally know if a follow-through worked within the first 2 weeks. So again, I think the pertinent point that I was raising out it is something that I'll repeat again. I think 20% retracement is what we had seen. And yes, a follow-through day was observed, but I think the markets have still been in limbo. From the follow-through day, as I mentioned, of 8,600 on March 31st, we are again almost 7 to 8% off. So again, I think there is some element in terms of distribution on how the indices are performing at this point of time. The key moving averages, as I said, are still extremely soft for a lot of market leaders at this point of time, which is obviously getting played out with market strength for these leaders still not exhibited through right basis formed at this point of time. Is there value for a lot of sectors at this moment? Yes, but can that value erode? As I said, because there is a lot of uncertainty in terms of earnings and how earnings will play out for a lot of sectors, and the next 2 quarters, this and the next, will throw out how much of that impact has been for a lot of sectors and stocks at play, will play out in terms of the fundamentals, and that will get reflected in terms of market data, in terms of price, in terms of volume action, which I think the base formations or the chart formations will throw out at us. So again, I think the next few weeks are extremely critical, and therefore I think having a close eye or a close watch in terms of the buy watch list that we've created and which is exhibited on our product Markets with India is for all the viewers or the participants who are registered. If you're not, I think request would be to get yourself registered so that you have all these elements at play in terms of what the buy watch list is. And as I mentioned earlier as well, I think a lot of the charts in terms of the fundamental data that is put through, the chart formations that are automatically put through in terms of our innovation and the products that we've got get displayed out without any human biases. And obviously, we are here to help you out in terms of the entire Markets with India research, the data research team as well, to aid and guide you through the entire process in terms of stock picking and your elements of identification of the stock direction as well. So largely, again, I think if you probably look at how the indices have rebounded, I think bear markets, as I mentioned earlier, I think they come in 2 or 3 waves. So I think the first wave normally, I think, is somewhere which gives a very false signal. So you've already seen that happening, right? So whether it's a Dow, S&P, or the index at play, from the low levels that we've seen of 7511, as I mentioned, I think on March 27th, it touched an intraday of 9,038. So there was a intraday low to high rally of almost 21%. which the indices have played out. So that clearly reflects that during such bear markets, I think you always got rallies like these. You've got waves like this, which also gives you uh, uh, an element that you probably missed out. So the feeling of missing out, the FMO as we call it into the markets, really get played out. But at this point of time, keeping your sentiments in check, keeping your attributes in check in terms of identifying how the stock indices are moving, whether the indices are moving on some valid reason, whether the technical indicators or the base formations have formed very, very clearly are extremely critical. So the next 2-3 weeks, I think you get these fizzle out rallies, but they fizzle out equally fast as well. So from the intraday high of 9,038, where we are positioned on April 3rd at this point of time, at 8,080, again, I think you've seen a significant 10-11% correction from the intraday high. So these kinds of volatility take place. The VIX probably fluctuate. The VIX had moved significantly higher in the peer trajectory. It's somewhere cooled off over the last few days. But I think all these fundamental impacts are still expected to play out on the markets, which will get play out in the index. I think the next 2-3 weeks are extremely critical. Therefore, maintaining a close eye and a hawk eye in terms of the watch list, in terms of monitoring the market movement, in ensuring and also understanding that you do not undercut the low of 7511 that we created on March 24th. And if we are able to sustain our head above that, and if we are able to rebound over the next 2 to 3 weeks, sustaining higher volumes, creating stable base, I think that buy watch list and any additions that probably happen in that buy watch list in this time period, which will get reflected in the buy watch list on the product itself. I think those are signs that I would watch out for. Those are the stocks, because those stocks will have leadership traits displayed within themselves, within the group, and within the peer itself as well, which will stand out if the markets do sustain over the next 2 to 3 weeks. And they can give, in my opinion, two things: one, reasonable and better returns compared to the other, and there is also a huge expectation or a huge probability that if that happens, I think the bottom of 7511 can truly be called as the market bottom, which we try to find out. So I think the next few weeks will help us answer all our questions actually. So I think we've just drawn a parallel in terms of why a follow-through day is important. If anybody follows lawn tennis, I think if you're doing a ground stroke, whether you're doing hitting a forehand or a backhand, you cannot stop your stroke halfway. I think if you take your stroke right above your shoulder, that entire element of hitting the ball in front of you, like Roger Federer hitting at this point of time, and carrying and moving your racket swing right above your shoulder, that terminology in lawn tennis is called as a follow through, right? So like that follow through, the tennis action that we're talking about gives the consistency, the pace and the execution and the timing for carrying the ground stroke in a perfect fashion. This follow through day, if followed perfectly to the T, and a proper follow through day, will give you the right time to enter the market and the execution for all the stocks within the buy watch list to ensure that the ROI or the maximum that you can attain from your stroke is attained itself. So just a parallel that I've probably drawn through lawn tennis and the follow through day that played out there. Now let's talk about how follow through days have taken place over the past crisis. I think we've also got a report on this, a very exhaustive one. But this report is very much there on the site. Registered users obviously would have got this. Anybody who's not there on our registered list, I think a request if you can log on. Just a few details that you need to fill in, and the report is there for your liking. So in 2004, the Nifty had corrected a reasonable 36%. Now the first follow-through day. So if you look at the table itself, the previous all-time high during the 2004 crisis was on 1st September 2000, on January 1st, 2004. Then the Nifty had hit 2015 odd levels. Now, when you probably saw the first follow-through day, which took place on Feb 27, 2004, it had taken place after all these elements were observed. So the all-time high, the retracement had happened of 36 odd percent. We obviously waited for 3 days in terms of consistent rally being shown by the market, but the market not undercutting its lows. And then the follow-through day was observed on Feb 27th, which had a huge gain. So what we normally and ideally talk about a 1.7 to 2% gain in terms of index movement with higher volumes compared to the previous day. I think that day was observed on 27th of February with a 5.5% gain on the index itself. So over the next 6 trading sessions, if you look at the next columns itself, the Nifty made or attempted to do an advancement of more than 6 odd percent. So from the follow through day, it actually had a 6% gain to almost 1,900 odd level. But over the next 10 trading sessions, again, I think the pullback was observed. So again, I think the point I'm trying to drive, and which I'll drive to all the crisis periods, is that during crisis periods, I think the markets are trying to find its feet on what the crisis is all about. After a significant correction that you probably see from the all-time highs, the market is trying to gauge on where we are positioned at this point of time. How hard is the earnings hit going to happen? How much time is the earnings recovery going to take place? What are the implications in terms of key macro data points, whether it's the global GDP that you're talking about, the global trade, how the PMIs are stacking up for respective economies, how the IIP numbers are stacking up for respective economies, how the global demand dynamics are playing out from a current account deficit perspective. Crude has played a spoil sport this time round as well. So I think it's three factors: the pandemic, the crude factor, and also I think the credit risk awareness in the system itself, as I mentioned earlier, which has also created a huge amount of uncertainty for the market itself. So I think all these factors on a micro scale need to be played out, and that's where the market is trying to find its feet. The market is trying to tell us both through price and volume action in terms of technical parameters, apart from these fundamental aspects which are obviously getting gestated by the markets over a period of time after such stark corrections, and those price points are felt up and getting displayed in terms of the technical basis that are created, that are getting formed. If we enter into a time-wise correction, if the market starts to gestate a lot of things, that will start getting reflected through the technical parameters itself, through volumes, through the price action, and the volumes will start drying up after all the heavy selling that we've probably seen. Also, there will be an element over the next few weeks and months of institution action or buying interest starting to coming back. So I think all the institution selling that you probably see along with the retail selling, as the market stabilizes and as institutional action starts coming back, I think the leadership trades start getting displayed for a lot of leadership position stocks, which I'm mentioning again, I think gets displayed through the buy watch list that we create. And that itself gets displayed in terms of that canceling methodology that I was talking about in terms of the fundamental factors of earnings, the newness of products, the institution holding, and the other elements in terms of supply demand factors which are played through price volume action and market direction trades, which are obviously played through in terms of how the market stack up is happening. Now, the first row, obviously, I think there was a pullback of 7.5% over the next 10 trading sessions from the high. So I think the next 4 sessions after it hit an all-time high, I think were very, very clear in terms of market direction, actually declining 7.5%. Again, I think we waited out in terms of when the next follow-through day took place. So the next follow-through day again happened after a few days, and the advancement there again was a 5.5% gain. So the market again tried to find its feet, and again it tried to attempt a rally of 5 odd percent. But over the next few sessions, again, I think the fall was quite substantial because the markets then were still grappling with the facts, as I mentioned, all these facts over the last few minutes. And then there again, I think the fall was quite substantial. So the 29% fall that we saw then over the next few days were quite stark for the market during the 2004 crisis. Finally, I think when you probably talked about the final follow-through day, which was very, very successful, I think it was June 24th, when the follow-through day actually started taking place. That follow-through day and the market movement which happened after that was quite substantial. Now, what was the differentiating factors between the first through follow-through days and the third one, which was very, very successful? I think the base creation, as I said, when I previously took you through, I think the technical corrections, the instability in the market because moving averages had been taken off quite significantly, and the leadership position not being exhibited, along with the V-shaped recovery through intermittent bull market rally in the bear market that we saw, were clearly getting played out. During this period after the follow-through day was observed, I think the market slowly and steadily started finding its feet. It did not undercut its load that it created. The volume and price action started coming through. The market had to a certain extent gestated over that periodicity of time through the first follow-through day that we saw on Feb 27. And what we actually saw in the next few weeks and months, that the market actually saw that there was a fair bit of element that the market had gestated that the worst is probably over. And that was reflected, as I said, through a proper base building structure that got created. Leadership stocks started showing signs of stability. The fall was not very obvious. They started coming out with taking out their better averages. The base formation was very clear. So again, I think all these elements need to be formed at this point of time in 2020 with the sharp fall that we've seen, a sort of V-shaped bull market, a bear market recovery that we saw. And again, I think the correction that we are seeing, we actually need to wait out. And that's why I think the buy watch list and waiting for a proper follow through day obviously becomes very pertinent. Now we can continue that through a chartical representation on how that entire 2004 crisis got played out. So I'll just take 10 seconds for all of you to observe how the chart has taken. Now, 2008, and a lot of parallels are drawn on 2008 and 2020. And as I said, 2008 was more about the financial deleveraging being taken into place. 2020 is more a combination of both financial and economic deleveraging. So I think the impact in 2020 is far more serious because I think the unknowns and the uncertainties are not just based on financial deleveraging, it's also economic deleveraging, which nobody is sure about. And everybody is guesstimating or estimating the next 2 quarters are going to be bad in terms of GDP cuts, in terms of earnings cuts. But how bad are they going to be? It's only time over the next few weeks, and we can just state that the worst probably might be a higher earnings cut. But have the market gestated that in terms of the total fall that we probably seen? Can we further make or retest our lows? That's absolutely a possibility which still remains very open. Therefore, I think any V-shaped recoveries that take place into the market, we've put out our note when the follow-through date did take place a couple of days back. That in scenarios like this, I think you should be very careful in initiating positions. You should be observing the buy watch list. A V-shaped recovery normally is susceptible for strong pullback. Those strong pullbacks actually can also take you to the lows that the market had created earlier. There is also a high chance of undercutting of lows. If you've read and seen our earlier report in terms of market bottoms, you've clearly mentioned there in terms of previous crises that we are discussing right now as well in terms of follow-through day actions and how previous bottoms were created, but how I think the undercutting of lows also kept on taking place during the previous crisis, and it might very well happen at this point of time. Therefore, I think you need to be very watchful. It is quite possible, as we have seen in the past, that the follow-through days actually might fizzle out. The next few follow-through days, and we've just seen one, as we've seen earlier in 2004, 2008, and higher element of follow-through days, which is getting played out in 2020. And as I said, we are having a dual effect in 2020. 2008 actually had 4 attempts in terms of follow-through days before the 5th actually played out. But I think 2020 is no different. So I'm not trying to draw parallels that we might have 4 follow-through days here, but there is a strong possibility looking at the economic carnage that we are probably looking at globally, what can happen in terms of even the package of 1.7 trillion announced locally at this point of time, the uncertainty related to earnings outlook for a lot of sectors, including banks, autos, and they become important and integral parts in terms of the index constitution and the moment itself, and how they play out is going to be extremely critical for the market to find its base. And therefore, I think being very cautious and observing stocks over the next few weeks, over the next 2 to 3 weeks, as I said, is critical both from how the market data and the data points will get thrown out locally, globally, as well as from an earnings perspective, because also a lot of earnings will start flowing out for a lot of companies, not just in India, but even in the US markets. So 2008-20 will have a lot of parallels at play. 2020 again, as in for the purpose of repeating myself, has 2 fronts to tackle with than 2008. So 2008 again, I think as a table you can see. I'm not repeating because I think it's very obvious on what we've written in the presentation itself. I think multiple attempts were made in terms of trying to find the feet, in terms of trying to find stability in the markets. The follow-through days were observed, but as Randy had pointed out, and as I pointed out as well, I think there are sufficient signs that value has created after a small, sharp fall that we've seen. but have the technical indicators come out fully, both from a market sectoral perspective as well as a stock perspective. I think the base structure still needs to get formed very, very correctly, very, very perfectly. That will happen over the next few weeks. Therefore, I think the next 2 to 3 weeks become very, very critical, both from the data points that will get shared fundamentally, and that will get reflected in terms of market price and volume action. Therefore, I think we should be keeping a close eye on how the market direction will be, as I've explained earlier, in terms of keeping an eye in terms of how many stocks get added to the buy watch list, and how the buy watch list is actually getting formed, which sectors are getting skewed within that buy watch list itself, and which leaders within those sectors are getting included. So 2008 had enormous and huge volatile moves in terms of percentage gains, in terms of the declines that we've seen. The second follow-through day, even if it had a very similar pattern to the first one, had a sharp pullback. The fourth one was the most horrendous. So I think, as I said earlier as well, I think the ultimate follow-through day will obviously have a huge panic reaction. Whether that has a panic reaction, which again takes us close to the market bottom, but it doesn't undercut, and their price volume action sustain, and if it stabilizes and takes higher and higher from those levels, I think that will be a strong indication that the market bottom would be the bottom that we're probably looking at over the next 2 to 3 weeks. Else, I think if it undercuts, I think the market is still under pressure, as we've seen in the past. The 2004 last follow-through day, before the last follow-through day, was actionable and actually performed exceedingly well. The market reaction before that was pretty stark and pretty knee-jerk as well, which was also seen in 2008. So again, a chartical representation in terms of how the entire follow-through days took place. I mean, you look at the actions, I think there were pullback attempted after the follow-through day, but there were again corrections that we saw. The final follow-through day, again, I think had certain elements to that. And undercut its low. So I think you need to be cautious today right now. I think there are high chances, high elements in terms of the positioning that we've got fundamentally, the position that the markets are also placed technically because of 20-25% correction that we still are from the all-time highs. The sharp distance that we are still away from the moving averages, that is the 50, the 200, the 10 weekly, the 40 weekly moving averages. And again, I think leadership stocks not exhibiting enough strength to probably give us the conviction that we go out there and then convincingly go out and buy, even in this market, even if it's in a confirmed uptrend. So I think this chart probably shows it all. I think it's a large parallel that we can actually have into account with the 2020 aspect as well. So I'll take just 10 seconds for you to just see the chart. You come to the 2011 one, and I've tried to draw about the Indian crisis moments. Again, I think if you look at how 2011 played out, I think 2008 was far more different. I think they tried the follow-through day attempts were made 3 times before the final would work. The gains during the follow-through day were significant because we anyway expect a 1.5-2% move in the index itself. So like 2008, where the gains were substantial for follow-throughs, I think the gains were very, very substantial. But look at the correction. I think there was far more sort of trading desk sessions that the corrections took place. So a large element in terms of the corrections being consistent, but the corrections being there in the market till the market found its feet over the next few weeks, I think was very, very critical. And that again is something that I'm harping upon, that you probably need to keep this into mind and into your cognizance, that the next few weeks are going to be very critical in terms of finding the base, in terms of us hopefully finding the market bottom, and for us in terms of understanding what in terms of the sectors and the buy watch list stocks which can do exceedingly well if all these factors hold up. So here again, I think the chartical representation in terms of how this entire move happened. Again, I think like in 2008, I think there was an undercut which happened for the Nifty. So there are elements, as I've said earlier, because of all these crises that we've mentioned in the past, There are pullback rallies which get attempted within the bear market rallies, quite substantial ones that we've also seen over the last few trading sessions as well. But there are chances that the markets still are trying to find the implications in terms of how this entire scenario will play out. All the factors that I said at the beginning of this webinar, I think are still true. They still hold true. Nobody's really sure on how they will play out over the next few weeks or months. And therefore, that uncertainty lingering on that market can actually still get played out in terms of price volume. And therefore, I think observing the markets in terms of whether distribution days are stacking up over the next few weeks, whether this attempt that we've got in terms of a confirmed uptrend is holding up, whether this market has the feet and the stability and the strength getting reflected through the index movement itself and through its key sectoral or the constitution representations and the leaders within those representations or sectors itself holding up are going to be extremely critical. So I think 2008-11 was an obvious example where I think even if follow through there had happened the next few days and sessions, the undercut took place because of the uncertainties surrounding our 2000 is no different. There are a lot of uncertainties even at this point of time, changing from what we said, even if more lockdowns or the lockdown pressures globally or locally continue, if supply chains still remain little constrained, if production activities remain hampered, and if earnings hit is far larger than what we are expecting at this point of time. So nobody is having a worst case scenario. This worst case scenario and parallels drawn to the 2008 undercut that the low had done, obviously over a longer period of time, would take Nifty far lower. We are not trying to preempt anything of that sort. We are trying to say what the market data is showing. Therefore, I think it remains extremely critical looking at how the previous crisis and the rally attempts and the follow-through days have been to be very, very cautious because I think V-shaped recoveries are susceptible, as I said, for pullbacks. It has happened in 2008 and 11, where I think the undercut did take place even after follow-through days were observed. Therefore, I think one really needs to be a little bit more cautious and careful in the current market context as well. 2015, I think, was relatively more stable like 2004. However, I think, again, the declines compared to the follow-through day actions that we saw and the number of trading sessions did take time. So I think the market takes time. So I think the point I'm trying to raise here is there is no point rushing into the markets because the markets have fallen significantly. That there is a lot of value being created. I think there is a lot of harping which happens that इससे बुरा क्या होगा? काफी बुरा हो सकता है क्योंकि I think markets हैं. You have to look at data. You have to look at actionables which the market is throwing at us, and markets knows better than all of us. So I think let us be very, very clear that what the earlier instances have thrown up, if the markets have corrected as they have in the current scenario and context, everything is not attractive. Yes, I think the prices that we are looking at a few weeks back, the prices what you're looking at, as I've said, 30, 40, 50, 60% correction are happening because the markets are still trying to find its feet in terms of where the constituent or the index itself should be from an economic perspective, from a global GDP perspective, from an individual sector or stock perspective. I think how much hit or an earnings degrowth will that sector take? How will demand revival take place? How is the expectations in terms of operating leverage expected to play on balance sheets? Whether you stay away from leveraged, pledged companies, yes, highly debt companies are going to find it very difficult in an environment like this where demand is going to catch up very, very slowly. How is the earnings stack up expected to take place post FY21 and FY22, FY23? How is that entire ecosystem, both locally and globally, which is now intertwined, expected to take into account? I mean, all these factors is something that the markets will try to find out over the next few weeks. This market correction has been brutal because earlier corrections did take place over a period of time. 4, 8, 11, 15, I think even the trading sessions where the declines have happened, the tables that I pointed out to you, the charts that I pointed out to you, 8, 11 obvious signs where undercut of the lows happened even after the follow-through day took place because I think the markets were trying to still understand the economic implications. We've still not arrived at this position in 2020. So I think buying on dips, I think has happened a lot of times in the last few trading sessions. And it's always prudent that even if you chip in 20% buying on dips, I think the strategy rarely works in market conditions like these. because you're not really sure when the market is going to find its feet. It's equally true as well. I think it's only hindsight that the bottom and when the bottom will be formed will be known. But at least with this methodology at play, you've got a fair chance and a fair probability in understanding on when and how you can probably put your money. Our take is still that you should still wait out, watch the buy watch list, observe the market over the next few weeks. The market can still get into a limbo, as we've mentioned, as it tries to gestate and ride through all these facts. The roller coaster ride can still continue for the markets going forward. And therefore, I think the entire element of observing leaders, observing sectors and stocks within the leadership traits exhibited through the buy watch list becomes critical. But entering into the market at the appropriate time, which is not the time now, as again I'm pointing out, and conserving capital as has always been the mantra of William O'Neill globally, William O'Neill India, I think still takes into account. So I think in 2015, again coming back, the kind of declines that you saw were stark. The number of follow-through days or the decline factors were comparatively lesser in 2008 and 11. But largely, again, I think the third follow-through day actually worked. And then I think the moment was substantial because I think the index finally found its stability, its feet. And as I said, I think it consolidated, created a buffer base, and also created strong leadership traits for stocks within those sectors itself. So I'll just take a few seconds for you to observe the chart as well. Now, 2020, I think here we are, and we have corrected, as I said, the all-time high. This was on the closing basis, as I mentioned, of the intraday high that it created of 12,431. Where we are and where the follow-through day was observed on March 31st. Again, I think looking at the market positioning, where we are placed at this point of time, and at the point of repeating myself again and again, you need to be cautious looking at what history has shown us. We also need to take into account there's a lot of economic and technical factors at place at this point of time. 31st March, 8,600 closing basis Nifty, where we are landing on April 4th, 8,083. So we're already down 7% on the closing basis in the next two sessions that got created. There is one distribution day that has got added in the day after the follow-through day that was observed. Therefore, I think it becomes very, very pertinent that the next few weeks we need to be observant in the market, not be aggressive, but keep a watch in terms of how the market move is, how the market movement will take place, and the overall action that can be delivered through market data itself. So we are taking the human bias out. The market is the best teacher. We are all learning out of this. Our learning is that if history is to be believed, maybe I think the market can still show some signs of instability, volatility. There can be the retest of 7511 that we witnessed on March 24th, which is, as I mentioned earlier, both the intraday low as well as the corrective low that we've seen. Whether that happens or not, I think the next few weeks will tell us. If it doesn't happen, if the market forms a proper base over the next few weeks, the actionable ideas in the buy watch list come into play, and we can follow pyramiding structure in terms of doing those actionables. Unfortunately, I think in the next few weeks, I think the distribution count increases and we undercut the low. The follow-through day, as we've seen in the previous cases, might be a failure, and we might need to relook at the market positioning itself and probably again stay very, very cautious in terms of approaching the markets from that period of time. But the point here is that it does take time. You need to give markets time, and the market will pull data and actionable price points through price volume action that needs to get observed. The base structure will get created. Once that base structure gets created, because of the sharp fall that we've seen and the sharp pullback, I think these V-shaped pullbacks become very, very difficult in terms of assuming proper base structures being created, and they're always susceptible for stronger pullback. So I think it's finger crossed that we don't breach 7511. If we don't over the next 2 to 3 weeks, as I said, which remain extremely critical from a market positioning standpoint, there is every chance that if the stability is shown out through price volume, through sector leaderships, through stock leadership within those sectors, that we might have some winners at hand. If the undercut of the Nifty low does take place over the next 2 to 3 weeks, I think you've got an element where the market rise that we saw becomes suspect, and where again I think the market direction changes for the worse, and you again need to be staying put and staying on the sidelines. Cash is king. I think that is the mantra that is to be followed at this point of time. So with this, I think it's time for queries. I think I'll just take a minute or two for the stacking up of queries. I'll also be joined by my co-host Rushit. So both of us will, on a combined basis, try and answer some of your questions. If you are not able to answer a few questions that still remain unanswered for want of time, I think we will get back to you. So I think in that case, I think we will drop in a mail to you, or we'll try to get back to you as soon as possible over the next few days, and then get your queries answered. Yeah, so we'll take in a few questions now. I'm seeing there are quite a few questions here. So Rushit will answer the first question by the time I just catch up on my breath.
Sure, Mayuresh. So I think I saw a couple of questions regarding why the follow-through days are failing. Like I think clients are more interested to know that whenever the market is in a rally attempt, and then we observe a follow-through day, and then we move towards a confirm uptrend. So why are these follow-through days failing, and we are not able to rally a bit? See, as I think Mayuresh told that, let me add on that the current, if you take 2004, 8, 11, 15, or to this time. So this time the correction has been very sharp and it's dramatic. So this was not even of that intensity in 2008 also. So there are many stocks in Nifty 50, or you can say the major stocks, which have been some 5-year, 10-year, or some like 15-year low they have made. So in this situation, when the stock has made a multi-years low, there are always chances of dramatic buying in the stock, like 1 or 2 days of a rally. Some might be doing bottom fishing or whatever it is according to everyone's methodology. So in this situation, what happens that there can be a false signal, and that's what we have been always telling. So I want to reiterate our what we told since last 2-3 weeks, that the V-shaped recoveries are never sustainable, and follow-through day generally fails. But then the next question it coming is that why we are changing it to confirm uptrend. So why we are getting a bullish. So ideally we are not being bullish on the market. We are just changing our stance. It's a potential rally. So we never say that, okay, this is a rally, that's fine, but you should be very careful in this rally. So like the distribution day quickly came on the second day itself. And that's a big issue. Whenever a distribution day is followed by a follow through day, then you can consider that yes, the follow through day is a bit weaker one. And if you observe in India as well as in US, so in US also yesterday there was a follow through day and we have changed it to confirm uptrend in US. And the sectors that led on the day of follow through day were the laggards. Similarly in India, so some stocks like ONGC, XYZ, which are down to 60 rupees now. So they were rallying some 5-10%, and such stocks other which have been beaten down stocks, they were rallying some 5 to 7%. And that is the reason Nifty as a whole was up. So yes, it is a rule-based system. At O'Neill, we follow rule-based system, and hence we will consider it as a follow-through day. We will not have a human bias that the corona is there or the lockdown is there, and we do not want to change it to uptrend. We don't do that. We don't keep human bias. But yes, if you can see in our note also that we pushed on when we upgraded the market to a confirm uptrend, we were very cautious about it. And we have in our portfolio, that's the reason we have not taken any fresh position, and have also asked all our investors that whenever you take, if you have to take any fresh position, then be very careful in this market. Like go in a pyramiding approach, that if the market shows some strength, then and only then you start investing in the market. Over to you, Mayuresh.
Thanks, Rushit. So I think there is a question asked by Dheeraj Govardhanam. So this question is for the sake of everybody. The banking sector looks like that it will completely get demolished due to the lockdown and future NPAs. What is your take on this, and how you are looking into HDFC, SBI, and ICICI? So you're absolutely right. So if you probably look at all these stocks, they have fallen off significantly. Now there are three aspects Dheeraj, and for everybody at large. I think the non food credit growth or the advances growth for the industry, as I mentioned earlier, was around 8 odd percent. Now the private players were doing relatively better in terms of the advances that they had or witnessed for the retail sector. Now within the retail sector, it was more unsecured lending, whether it's credit cards or personal loans, which had a huge say for a lot of these private lenders at play. The public sector counterparts obviously had issues of their own, because I think merger issues were something that were getting played out and are still getting played out for a lot of these companies. Tier 1 ratios, which is the capital adequacy required for balance sheet growth, is extremely weak and soft for a lot of companies at play again. The third element obviously is also the stacking up in terms of how the personal advances have been. So I think a large skew in terms of PSUs is still towards corporates, SMEs, and SMEs. Now, even for the private parts, a few of the smaller private banks, because they aggressively needed to maintain their NIMs and spreads and create a larger NIM portfolio, had a huge exposure towards corporates. Also, the dependency in terms of deposits from corporates was huge. The third element that also took place was that once all this deterioration start taking place and these lockdowns, I think how the loan growth will take place. Second, the susceptibility in terms of asset quality issues for SMEs, MSMEs, the unsecured portion itself, the credit card, the personal loan portfolios, what if job losses take place. So I think there are concerns which are getting played out. So large element is on two counts. One, fundamentally, I think how these stocks stack up from an earnings perspective. I think it's better to wait out for and watch out for how the quarter numbers will be, because that will give you a fair idea on how the banking universe is playing out. Uh, and largely, I think the next quarter will be even a further example. So I think this quarter obviously will throw up some light and shed some light in terms of how the numbers will be. The management commentary on how they expect numbers to stack up. Whether it's banking, financial services, NBFCs have issues of their own, because they're ultimately dependent on a lot of sources for borrowing. With the moratorium created by RBI for 3 months, how bondholders and how their cash flows will play out, and how their cash flow management will play out from a liquidity perspective is also very, very critical. Certain NBFCs are also rural focused, so if there is some element of higher delinquencies on that front, there can be some elements where I think you can have some portion that can still get disturbed from an earnings perspective. So fundamentally, all these reasons are taking place. Technically, I think they've got broken down big time. So if you look at the exuberance and the kind of confidence that these stocks exhibited before the fall that I saw, 12,451 in the middle of Jan and where we are right now, I think all these factors are getting played out because the fear factor have played out, because the markets have corrected, the high beta correlation that they've got. The price volume action has got played out very, very significantly. So the markets will now ideally like to see how these stocks settle. So for the banking stocks in general, I think again the classical argument between value and price. There were so many arguments laid out in Jan, December, that people are buying at price to book multiples of 2.5, 3, 3.5, 4, 4.5 times. For certain housing companies, more than 5.5 times. They've actually halved at this point of time, but the confidence is not there, because I think the market fall, the sentiments have got sour. The numbers stacking up, as I said, concerns fundamentally are all getting displayed on price volume. So the ideal thing is wait for quarter numbers. If the numbers are good, if the management commentaries are good over the next few weeks, I think if general stability is there, the high beta correlation will, if the market stable, I think the leadership traits can get exhibited. But I think the can factor is very important. I think we're not trying to guess or guesstimate or estimate anything here. So the can and may, I think the probability and possibility factors, once they start coming through, becomes highly unlikely for anybody to start taking aggressive positions. Even if you have, look at how, just as an example on how IndusInd performed. It touched a low, it had a huge run in the pullback rally. Again, it, I think, reversed back. So I think it's better waiting out in terms of numbers, waiting out for the stock to create a proper base. And therefore, I think the next few weeks will be critical for banking. Is there a value? And there is definitely value, but wait out for the market and the data to to show you the right time. So as I said, I think when to time it is going to be critical. This is probably not the time. And there is no element in terms of saying that, over the next few weeks or months, if the market bottom had to form at whatever level and the stocks perform, we don't mind uh, losing out on the first 10-15%. But I think let there be stability rather than periods of volatility where you're putting in certain amount on every day and then you're probably doing nothing because the market itself is doing nothing. I think it's better off that you wait out rather than try and preempt anything on that sort. Over to you, Rishi.
Yeah. So I have a couple of questions regarding our ratings. So one, Sujit Basu has asked about the buyer demand and price strength. So why does it keep changing every day, and what exactly it is? So Sujit, the buyer demand and price strength. So price strength, we also call it as a relative strength. So we track it on a daily basis, and you can see that it may change on a daily basis. So what buyer demand is actually, it's an accumulation distribution rating. Buyer demand can also be said as AD rating. So whenever there is a change in the prices, like the stock is getting accumulated on a volume or it is getting distributed, so we have a ratio of it, and so it rates from 0 to 99. And just to simplify for you guys, we put there a grading like A, B, C, D. That's how we put up the buyer demand. But buyer demand is nothing, it's an accumulation distribution ratio which is calculated from 0 to 99. And yes, it keeps changing on a daily basis, and especially in the times when the volatility is higher, you may see that there is a lot of accumulation distribution happening, and so it keeps changing daily basis. Similarly, it's about the uh, buyer demand, which we also called as price strength, which is also the relative strength. So we always look for a leader in at William O'Neill, and so to get the best price performer, we look at the relative strength. So it is calculated and compared with all the other listed companies in NSE or BSE, and we on a relative basis, as the name suggests, the relative strength. So we calculate it on a relative basis, that how strong is that particular stock performing in terms of price in the last 12 months. So on a daily basis, when the stock is trading, you will generally find that the relative strength keeps on changing. So yeah, this was about that. And then one more question is there, that from Milan Shah, that you guys are discussing about pyramiding approach or pyramiding philosophy. So what is it and how exactly it is? So see, pyramiding involves buying in installments instead of all at once. So this is what basically a pyramiding approach is. You buy the first piece with some XYZ amount. Say for example, if you want to invest 100 rupees, and you invest some 10 or 20 rupees in your first installment, and then as the market goes in strength, as the stock that you are investing goes higher, you will keep on investing. We will never do the buy the stocks on the way down. This is not our methodology. So in pyramiding strategy, we always look for buying in installment whenever the stock price is moving higher from an ideal buy point. So that is also an important. It is not like you buy it at any point of time, but whenever the stock is breaking out of a consolidation area, retaking its key moving averages, or like a cup with handle flat base, it is breaking out of those areas, then in an ideal buy zone or around that region, we generally suggest a pyramiding approach when the markets are very volatile. So volatility VIX is around 60, 70, 80, it's roaming around that region. So it's always better that you go for a pyramiding approach. Over to you, Mayush.
Thanks, Ruchit. So, in continuation with what Ruchit was saying, Milan had also one question: what are the scripts or the buy watch list that we've generated, right? And where the philosophy is getting maintained. So, I think I always maintained that consumption and pharma in volatile times like this, I think both from an earnings perspective, because earnings will relatively hold up better for these two sectors. And again, in terms of deterioration of earnings, it should not be as stark compared to the others. Yes, there will be some issues because a lot of these companies have also come out and said that there might some supply related issues, supply constraint issues, packaging related issues, so on and so forth. But I think two of these sectors, still this entire volatility period over the next few weeks and months does not subside. I think these two sectors will take place. I think in lieu with the recommendations, I think what we've got on our buy watch list is something like an HUL, and they are watch lists again, right? So Nestle, so consumption pack very very strong. We've got Dr. Reddy's from the pharma space, Ajanta Pharma, and anybody holding on to Ipca Labs. Should continue holding out, right? So Milan, I think that answers your question on that one. a lot of questions are being asked in terms of how this analysis will work over the next few weeks. Obviously, I think we are here to help you. So I think our methodology is such that the next seminars, and there have been 4 or 5 questions that I'm saying that how should we do that? When is the next seminar? So I think for all the viewers who are tuned in, I think we are planning to host this on a weekly basis. So every week on a Saturday, we are planning to host this for a couple of hours so that we are in tune in terms of how the market move has been. We are also in tune on how the market direction is stacking up. And it will also give you a fair bit of an idea on how we are looking at the markets at every length of time. So I think on a weekly basis is something that we are planning. So thank you for the interest evinced. But every week, I think we'll be here for you to answer all your queries, right? Over to you, Rushit, for anything else.
So Raj has one question, which is again related to the current today's topic, that's follow through day. So what Raj is asking that how we know which follow through day to consider for buying opportunity. So in past also he's telling that 3-4 follow through days have been failing, and this time also like the follow through day couple of days back after that market has reversed some 4 to 5%. So Raj, in this situation, so we recently discussed about a pyramiding buying approach. So whenever if you are buying, then that approach is really good. Secondly, you should always have a stop loss of 8%, or you can have even a smaller one. The one more important thing is like when does the follow through day generally succeed is when the market is moving about the key moving averages. So currently Nifty is more than 20% below its 50 and 200 DMA, which is really deep, and it's not even above its 21 DMA. So generally when the correction is very sharp and deep, we always look at 21 DMA. So if the market is Nifty is moving about 21 DMA and you see some good accumulation and follow through day around that point, then that is where you can be a bit more tad more confident about the market. However, you should be very cautious that 50 and 200 DMA are way above the current level. But if the Nifty is going about 21 DMA and if you find some positive momentum over there, then that is a good area of opportunity. But at that time also, you should not be all in. You should go in installment and be very careful about the stock selection. And secondly, once you have entered a stock, you should be very careful with the sell rules. So you should be at the top of sell rules, that whenever the stock is showing some sign like it is going down on a higher volume, what is the AD rating? I recently discussed it, that AD rating means like how is your price strength? Is the relative strength line dropping? So if these technical indicators are playing your part, then you should quickly be out of that stock and preserve your capital, because in this kind of market, as Meresh always told, that cash will be the king. So yes, this is how you can approach the follow through day.
Thanks, Rushit. So yeah, I think Floyd, Lewis, Tarun, Vig, and even Sanjeev Narula, I think they have got questions related to sector analysis. So I think Floyd, Tarun, Sanjeev, and everybody else as well. The next seminar that we'll do, obviously, I think I'll be taking you through the sectoral impacts. So I think you probably need to wait out for one more week in terms of a detailed presentation that will take you in terms of sector impacts. Why next week, you might ask? Because the earnings will start the week after that. So just a preparatory kind of a thing that we all will have in terms of how sectors are expected to get positioned right after this earnings season, and how an annualized earnings can also be taking place for a lot of sectors with the concerns that have got played out. So clearly, I think just one more week. I think the next week will be all about sector analysis and sector discussions. Also, I think what key sectors are actually getting thrown down through our sectoral rotation graph. I think that's going to be something that we'll discuss very, very clearly. But the way I'll put it is till the next few weeks and months, I think till the market, as I point time and again saying it, till it finds its stability, I think consumption, specifically, I think consumer staples, FMCG and pharma will be the sectors in focus. As there will be some element of stability that comes through over the next few weeks, you will see a knee-jerk reaction which will get played out by high beta stocks. So the beta correlated sectors will come into play. We might then, after that, enter into a time-wise correction where a proper base formation happens. So 2 ways of looking at it over the next few weeks or months till that proper base formation happens. and taking into cognizance the V-shaped recovery once that curve or the pandemic starts coming off. Till that point of time, pharma, FMCG staples probably are the sectors that one should look out for. I did mention a few brief buy watch lists that we have created for certain stocks. After that pandemic curve starts coming off, you might have a knee-jerk reaction on high beta correlation stocks. But then that time period after that, the entire thing subsides and that time correction happens and the market tends to find its base. I think a few sectors within these will emerge as the ultimate leaders for the ensuing rally that will follow over the next few months. So this is how I'll put forth. But wait out for a week for the detailed sectoral representation. Over to you.
Yeah, I think most of the questions related to today's webinar or even some strategy view has been answered. And I think there were a few questions regarding the sectors, but I think Mayuresh has made it clear that this is how we will progress in terms of our webinars. And we will touch on all those factors also. So I don't think there are many questions now regarding
Sure.
webinar.
So anything else that is remaining, I can see something related to margin funding. So I think all those operational questions, I think we'll get that answered through. So Shabindra had margin funding questions. Nifty Bs was something that was asked. So I think there are a few questions that have got asked. There's obviously a question which got missed out, which I'll cover, and probably this is one of the last questions that we'll take. Can we have the Nifty P for investment in Nifty Bs? Again, Nifty P, the multiples adjust as the market conditions change. So I think price earnings is nothing but an earnings on how the price of the market is positioned vis-a-vis the earnings that the markets will reflect. Now, obviously, as I said earlier, and at the point of repeating myself, the earnings deterioration is unknown. If you probably take a worst case scenario in terms of a larger or a higher double-digit earnings degrowth, which nobody is taking at this point of time, maybe the price earning multiples on a 1 year forward is probably justified at the current level of the index. However, I think if the earnings deterioration is far lesser, I think if the lockdown pressures come off, if the supply chains and the production numbers and the demand comes back very, very strongly, contrary to the expectations that we've got and globally analysts have got, I think that can create lesser earnings impact, and that will get reflected through the earnings of the P&L reported numbers and also through price volume action. So again, I think it's an unknown. So I think PE contraction is obvious because of the expectation. How much of that contraction will happen from an earnings perspective, I will decide. Therefore, I said this quarter, next quarter is going to be critical for a lot of sectors which are high beta correlation. I think these quarter numbers are going to be extremely critical. How the management numbers, how the management commentaries play out, and how the number deterioration happens. A small portion will get captured this time around. A larger portion will get captured for the next quarter's numbers. Therefore, it will become very, very critical in the juxtapositioning of high beta correlation stocks, and therefore I think these quarter numbers become important. We'll have a detailed webinar in the coming week on sectoral impacts and sectoral positionings. Till that point of time, I think thank you everyone for joining into this webinar. Stay safe, stay healthy, maintain social distancing, and hope to see you all around in the next webinar as well. Take care.